Good evening, everyone. This is Financial Literacy 101. I just had a couple of things on my mind thinking about the many different ways on how you can actually pay off your mortgage for your home a lot quicker or even your condo. So there are some very basic ways, and there are some very ways that is not known mostly to the public, but it's public information. It's not like your mortgage, whoever's providing the loan, your lender is going to actually give you this information. But I'm going to break down this information to help you guys pay off your mortgage a little bit faster. That way you can be a homeowner a lot quicker than most people are in 30 years. Okay, so first and foremost, we need to understand there's many ways to pay off your mortgage, but the first thing that you need to do is check with your mortgage company. That's the first thing you need to do, because some of these mortgage companies only accept extra payments at a specific time, or may charge prepayment penalties. That's correct. They may charge you for paying extra on your mortgage as a penalty, okay? Because essentially within those very long eluded contracts, you're signing what, 100 some odd sheets of paper on your house. All these adjacent paperwork may have that you can't pay off your home early or make extra payments. So you have to make sure with your mortgage company that it is okay for you to apply extra payments. Make sure that's the first thing that you do, that you are allowed. Secondly, it's probably best to include a note on your extra payment that you want it to be applied to the principal balance and not to the following month's payment, because that's what they'll do, because they want the interest. They want the principal to compound. What you're trying to do is break down the principal so you knock the interest off, so you pay just the amount of the home and not the interest. So of course you have to make that note that, hey, these extra payments, this extra money, I want that to go to the principal and not to the following month's payment. Okay. So one of the quickest ways that I found out to pay off your mortgage is to make bi-weekly mortgage payments. That's right. Bi-weekly mortgage payments. That don't mean every 2 weeks you're paying your $2,000 or $3,000, whatever your mortgage amount may be. See, the concept of a bi-weekly mortgage payment is pretty simple. You make half of your mortgage payment every 2 weeks. That results in 26 half payments, which equals 13 full monthly payments each year. So that extra payment can knock 8 years off a 30-year mortgage, depending on the loan's interest rate, of course. So let me say that again. By you making an extra payment, that means every 2 weeks, you're only paying half. That results in 26 half payments, which equals 13 full monthly payments each year. And again, that extra payment can knock off 8 years of your mortgage, of a 30-year mortgage, depending on the loan's interest rate. So you're probably asking, well, how do I set up a biweekly mortgage payment? Now, first and foremost, locate the principal and interest portion of your payment on your monthly statement and simply divide that number by 2. Okay, for example, if the principal and interest portion of your payment is $1,500, your newly bi-weekly mortgage payment is $750. So every 2 weeks you're paying $750. But don't forget to include the tax and insurance portion of your payment each month. In this $1,500 payment example, the $750 bi-weekly payment only covers principal and interest. So you'll have to pay the tax and insurance portion of your payment in an additional fee. Find out how, or if your mortgage company handles bi-weekly mortgage payments. Some lenders will process bi-weekly payments while others refuse to accept partial payments at all. See, a lot of these mortgage companies have these little hidden clauses, these hidden fees. So you have to make sure first, before you do anything extra with your mortgage payments, make sure that it's clear and that is allowed through your mortgage company. Because in any case, do not pay a fee to initiate a bi-weekly mortgage plan. Some of them may charge you a fee, and that's what you don't want to do. You don't want to pay more money so you can pay less money up front. It makes no sense. You're actually working in reverse. So if your lender isn't open to bi-weekly payments, open up a new bank account exclusively for your mortgage payment, deposit your half payment every 2 weeks, and use that money to make your full mortgage payment either by check or automatic transfer options or payment options on every second deposit. Now, a biweekly payment is not a substitute for intensity. Once you reach step 5, start putting as much money as you toward the mortgage to pay it off even faster. These are some of the quickest ways that you can pay off your mortgage, ladies and gentlemen, very, very quickly. Okay. So here's another one. I thought of this. I was talking to a buddy at the cigar lounge, and I said, you know what? How some of the ways that we can actually pay off our mortgage a lot quicker. And I thought of something. My real estate, buddy of mine who lives on my same block is a real estate agent. And he told me that per square foot in my neighborhood, that the comparables, the comps, are $167. So my house literally has went up $200,000 in less than a year. I said, okay, I bought this home for around $400,000. And you telling me that my house is worth over $600,000? He said, yes. He said, because of, the housing market being hot right now. So that got me to thinking about, here's another way to pay off your mortgage or a mortgage in less than 15 years. What if you went to a new development? And this usually only works for new developments, okay? New developments, or where you bought your pre-existing home, they're building a upscale mall or upscale mini mall or upscale or surrounding activity areas or something like that for families. So take, for instance, this neighborhood. This neighborhood is only 5 years old. The previous owners moved out. They made 20 grand off their original house buy. They bought this home for $370,000. I bought this home for roughly $400,000. But because of the wave of people doing mass exodus from New York and California, this particular area, because this is a nice area, don't get me wrong, it's a nice area. So a lot of them are moving with their money from New York and also California. And these houses in California in certain counties and certain cities are worth $1 million plus. So they're coming to Texas, okay? They're coming to Texas and Arizona and buying house with cash. So they're buying over the asking price because they're getting a mansion considerably to what they had in New York and also California. So this only really works, in my opinion, when it comes to new developments. Think about new developments. New developments, depending on the prestige and the certain amenities and activity centers that they have in that particular area, will tell you the value of that area up front. So people who moved in this neighborhood, they were paying anywhere from the high $200,000, $289,000, all the way to $370,000 for their home, depending on the size. Like my home is roughly, I want to say 3,700 square foot. Okay. It's too much house. There's only a couple of us living here, but nonetheless, I knew that this was going to turn out to be good. But here we go. So when this area starts to accumulate value because of the equity, and although the surrounding areas are are being built up around it, this home has went up $200,000. So what is that telling you? If you can get into a new development and wait anywhere from 3 to 5 years, you may not have the same return that I have, but your house may go up $50,000 to $100,000 in that 3 to 5 years. Okay. That's kind of the usual amount, at least 50 grand that you can make on your house. So what am I getting at? So you can sell that home and then find either a new development or move either north or east, usually in some states where the housing is a lot cheaper. Now, a lot of people don't like to uproot themselves, but this is an investment opportunity for you guys to pay off your home in a very short time. Now, I thought about this. So if I have a $400,000 loan and my house is worth over $600,000, and I sold my house, I paid off my loan, and I look for me a very small house just for me and my fiance, I can still be paying off my house in less than 1 year, 5 years, or even 10 years. But there's different methods for you to pay off your home very, very quickly. But there are some things that you may have to do. Like, what if you could make an extra house payment each quarter? You pay your mortgage off 11 years early, and you'll save more than $65,000 in interest. Can I say that again? So a quarter is whatever you may think it is. It's either every 3 months or every 4 months. But what if you made an extra payment? Like right now, if you are in work and you're not unemployed, you're not drawing unemployment, good for you. But for those who are unemployment, this is still maybe getting information if you have the feasibility and the financial stability to do so. So in 3 months to every 4 months, if you made an extra payment, you can pay off your mortgage. You can pay off your house in 11 years and save more than $65,000 in interest, because you're going to be killing the nanny. You're going to be chopping off the head of the dragon, knocking down that principal. Now, this is something that more so I wrote on my list, but it doesn't really apply in today's economy with, the virus that's going around. Let's just say that the virus is going around is bring your lunch into work and making your own coffee from home. I say that plenty of times and times again. Here's another option for you guys. What about refinancing your home? See, the only type of debt that I essentially won't tell you that is a bad debt. Well, there's two types of debt that I say there's probably not a bad debt. There's a business debt and also a house debt. But when it comes to refinancing a 30-year fixed mortgage to a 15-year fixed rate mortgage with a payment that's no more than 25% of your take-home pay, you'll pay much more in interest on a 30-year mortgage. It's a no-brainer if you can afford to cut the head off the dragon and pay a 15-year fixed rate mortgage. I really want you to think about that, because my interest rate went from 3.25 to 2.25 when I refinanced. And what that did for me, let me just do the math very quickly. See, 8, 9, 10. By dropping 1% in my loan, can I tell you guys how much I saved a month? $800 off of 1%. I know it's staggering, but here's the kicker. When we refinance, it's considered a new loan, because that mortgage company is going to pay off your own home, and then your credit is going to accumulate, is going to assume another loan on your credit. But you already are factoring that your credit is going to go up, then it's going to go back down again, and then it's going to settle. And that's perfectly fine. But the question is, why you refinancing? I always tell people, if you're going to refinance, make sure you're refinancing off of 1% or more. Meaning, if your interest rate for your mortgage is 5%, if you can refinance the 4%, if you can refinance it to 3.5%, believe me, you'll be saving anywhere from $300 to $1,000 on your mortgage payment alone. But if you was already paying that mortgage payment for, say, 2, 3, 5, 7 years, I want you to continue to pay the same amount, because you will be literally knocking off 10 to 15 years off that mortgage if you continue to apply that same amount. Now, most people, of course, refinance and save money paying that particular mortgage payment every month. But if you've been paying it that long, why not pay it for a couple of years more and absolutely positively pay off your house sooner than the 30 years that you have already signed up to have? Now, you can refinance a longer term mortgage to a 15-year loan. Or if you've already have a low interest rate, like, hey, man, I got 2.25. I mean, unless they go to 1%, I'm not going to refinance. I got you. I totally understand. But you can save on the closing costs of a refinance and simply pay on your 30-year mortgage like it's a 15-year mortgage. So if you already have a low interest rate on your 30-year mortgage, you can save on the closing costs of a refinance and simply pay on your 30-year mortgage like it's a 15-year mortgage. The same goes for a 15-year mortgage. If you can swing it, why not increase your payments to pay it off in 10 years? So take, for instance, you 30 and you can pay off your house by the age of 40. If you're 40, then 50, then you're 50, then 60. But there's seniors over the age of 60 years old, 65 years old, still paying on a house mortgage. Now, I know if you could pocket $1 to $2 grand in your pocket because your house is paid off and the only thing that you're paying is property tax, could you travel more? Could you invest more? Could you compound off the money that you'll be saving instead of paying into a mortgage? Yes, you could. Now, here's the one that most people don't like to say at all, that most people don't like to do. But I have to break it to you, ladies and gentlemen. You have too much stuff. Me and my fiance was talking. She said, babe, all this stuff is yours. I said, well, babe, I came from a 3-story house before. And my house was even smaller. It was a 2,800 square foot house, but I had a lot of stuff. I said, babe, we don't really buy that much stuff unless we're going to give some things away. But here's the kicker. Downsize your house. Now, I understand that downsizing your house could be a drastic step, but if you're set on getting rid of your mortgage, consider selling your larger home and using the profits to buy a smaller home, a smaller, less expensive home. See, with the profits from selling your bigger house, you may be able to completely pay cash for your new home. But even if you have to get a small mortgage, you've succeeded in reducing the amount of debt that you have. Now, your next milestone is to get rid of that debt as quickly as possible. The smaller the balance, the quicker you can pay it off. And people, this is a problem I see a lot of people get into. Do not bite off more than you can chew. Some of us, men and women alike, we get into what we want instead of what we need. So we go buy the biggest, baddest, most luxurious house on the block, and you know that's not what you need. You just need a 3 to 4 bedroom house with a couple of bathrooms and a safe neighborhood. And that's not living in the most expensive county, nor the expensive city, nor the expensive town in your state. So we have to start thinking with the big boy pants rather than thinking with your eyes. I see we got ACE Channel. He says, I would throw an extra money into the stock market to earn more money in return since interest rate is 2.5% for 30 years. Okay, that's not a bad method, ACE. That's not a bad method at all. If anybody got any comments, I am live here, so go and write your comments. I'll read them. And if they are some good information, I'll make sure that the public knows that as well, okay? So there's a lot of ways to pay off your house, because here's the thing. If you're biting off more than you can chew, one of the things that I'm going to say, hey, I'm debt-free with 3 to 6 months of expense and emergency fund. Do you have that? Can I make at least 10%? Preferably 20% down payment. Can you do that? Do I have enough cash to cover closing costs and moving expenses? These are the questions that you need to ask yourself before you buy your first home, your second home, or any of the homes you ever bought. These are the questions, because believe it or not, ladies and gentlemen, I learned something new. And this is what, my 3rd or 4th home? And I'm still learning. But the basics that I've written down here is that, hey, am I debt-free with 3 to 6 months of expense and emergency fund? Wasn't really debt-free, but I did have 3 to 6 months of emergency fund. Can I make at least 10 to 20% a down payment? Now, we understand, ladies and gentlemen, depending on your type of loan, if you pay 20% or more, you get rid of that PMI insurance extra payment that is actually added into your monthly mortgage amount. Then the other question, do I have enough cash to cover closing costs and moving expenses? That's the one thing that people really don't factor in. Closing costs and, Lord have mercy on your soul, moving expenses. Because the question you might have, well, we're going to do U-Haul, we're going to do Ryder, or we're going to do one of these pods, or we're going to have a company to come to the house and pack up everything. Ladies and gentlemen, let me tell you something. Packing, unpacking, to me is all the same. It's hard work when you're packing your own stuff, and it's even extra hard work when you're unpacking your own stuff. So read how you do, and guess what? No one packs it better than a packer, because they're usually insured. So if they break something, they pay for it. When you break something, you pay for it. It's a big difference. Now, the other portion of that is the house payment, 25% or less of a monthly take-home pay. Question, can I afford to take out a 15-year fixed rate loan? See, everybody gets into a 30-year mortgage, even me, because the payments are smaller. But what if you went in with a level head with a couple of dollars in your pocket and you say, hey, so are you looking to buy a house today? Well, yes, I am. And then they automatically think the average American wants a what? 30-year fixed mortgage. You say, no, how much is it for a 15-year fixed mortgage for this particular house? And see if you can afford that. Because again, if you're 30, your house will be paid off when you're 45. And then what if you took the 15-year rate mortgage, and you use some of the methods and strategies that I'm giving you here today, and you apply that, you can be paying off your house in what? 5 years. This is what this is for. This is how you do it. This is how you have financial freedom. And this is how you retire early. Financially independent, retiring early. And we call that fuego. We call that fire. The last thing, ladies and gentlemen, is maximize your down payment. If you know this is your dream house, you know that this is your retirement home, then maximize your down payment. The best way to buy a home, this is silly, but the best way to buy a home is with 100% down payment, meaning you're just paying off the house. Paying cash for a home may sound weird, but just imagine all the fun you can have without a mortgage weighing you down. If you can't postpone the purchase until you can pay, plan to put at least 10% down at the closing table. Or of course, 20% is even better because as I said before, you will avoid paying private mortgage insurance. Your PMI typically costs anywhere between 0.5% to 1% of the loan amount annually. For example, if your home is $250,000, PMI will cost you anywhere from $1,250 to $2,500 for a year. Think about that. You will be saving, if you could put 20% down on your home, you will be saving $2,500. And you know me, ladies and gentlemen, I love to take a vacation, and $2,500 is exactly what me and my baby need to go on vacation. We're going on vacation here next week. We're going to Jamaica. You guys know that I just came back from Brazil, and in November we went to Mexico. Okay, and later on this year we're going to the Dominican Republic. Somebody said, "God damn, man, you always on vacation." Yes, when you do right by your finances do right by you. And here's another thing. When you're giving the 20% to wipe away that PMI, the other question you'll have, why are you giving up 20%? The other question I may have is, why give the bank extra money each month if it doesn't pay your mortgage down faster? That's what your PMI does for you. It pays down your mortgage faster. So if you can gather up the mother, you can go out and kill wild bears in order to get the money, do that. But pay that 20% so you're not paying the mortgage company, the lender, that extra 0.5% to 1% in order so you can have private mortgage insurance. That is such the weirdest scam that these banks and mortgage lenders have come up with. Because you didn't put 20% down, we're going to charge you anywhere from 0.5% to 1%. If your home is $250,000 or more, that's $2,500 a year. I see we have Jermaine Anderson in the room. Thank you, Jermaine Anderson. I'm about to make you a moderator, Jermaine Anderson. Thank you for your hard work, brother. And we have Karina Maneno or Manono. But thanks for everybody for joining me this evening, and hopefully you guys got some information. And again, please give this video a thumbs up. Give it a thumbs up, thumbs up, thumbs up. And please share this to other people who are either looking for a home, who are in a home, who may be struggling to trying to figure out different strategies and methodologies and help them to pay their mortgage payments. This information is vital, and that is why I put this together for you guys. I love doing these surprise videos. I kind of stopped my nightly Thursday videos. I moved to my weekend cigar talks, but every now and again, I love just popping in, giving you guys some quick commentary, some quick advice, some quick information to help you live your lives a little bit better. And you can be seeing me in Jamaica when you get your finances right. But until then, I'll see you guys tomorrow morning for my stock review between 8:30 and 9 a.m. Central Time. This is Financial Literacy 101. Learn money and be inspired. You guys have a great evening. I'm out.